So we hear that interest rates are going up. Well, that also means that we're going to be seeing interest rates increase on student loans as well. It was just announced that federal student loans will have an interest increase for any loan that's disbursed on or after July 1st, 2022. So essentially for your upcoming school year, you can expect the interest to be higher. By how much? Well, every single federal student loan type has an interest increase of at least over 1%. May not seem like a lot, may not seem like a huge impact, but there are some impacts on these increases that will affect how much you're going to repay each month and also repay in total to pay off your student loans. Undergraduate students, so if you are borrowing a direct loan, which that could be a subsidized or unsubsidized loan, your interest rate for any loan disbursed on or after July 1st, 2022 will be 4.99%. For the last award year, so essentially any loan disbursed between July 1st, 2021 through June 30th, 2022, the interest rate was 3.73. So that's a decent increase of your interest rate. For graduate students, your direct loans, for your unsubsidized loans, your interest rate for any loan disbursed after July 1st, 2021 was going to be 6.54%, and direct plus loan borrowers. So that's going to be your graduate students and parents of dependent undergraduate students. If you choose to borrow a direct plus loan, your interest rate is going to be 7.54%. So that's a significant interest rate. During the pandemic, it felt like interest rates were extremely low, and now we're seeing them creep up again. So let's talk about a plus loan, a direct plus loan. If you're borrowing $15,000 for 1 year and your interest rate is 7.54%, for a 10-year repayment term, your monthly payment is going to be about $178.37. That means the total interest you're going to be repaying in 10 years on that loan is about $6,403.92, making that total loan cost $21,403.92. So you borrowed that $15,000. You borrowed in 2021 and you borrowed in 2022. 2022, the amount you borrowed is going to be over $1,000 more expensive than the loan you had borrowed in 2021. Obviously, just an example, but this is just to illustrate the true impact and the true cost to you to borrow money. Remember, interest is really the cost of borrowing money. It's assessed every single day with a simple daily interest formula. We've got a great article on edvisors.com which discusses simple interest and how it's calculated. When interest rates increase, you're going to be paying more over the life of the loan. Obviously, there's a few things you can do to combat it, which is, to overpay, try to pay it off early. But even before you get to borrowing, there's a few things you can do. You can make sure to only borrow exactly what you need and not a penny more. If you still have a few months before you have to start school, you can still look for scholarships. You can still look to earn additional money. If you earn money to help you pay off your college costs for your upcoming year, you might not be able to pay off the entire thing. You can actually ask your school, once you get your financial aid award letter, to reduce or reject a portion of your student loans, which will be easier for you to pay off once your loan finally enters repayment. Now, how does this affect private student loans? Well, private student loans and federal student loans, the way interest is set is completely different. The way federal student loan interest rates are calculated rely on the auction of the 10-year Treasury note. Once that is determined, then there's a calculation written in law on how interest rates are set for federal student loans. Private student loans, these are reliant on current market trends. We've already seen the Federal Reserve raise interest rates, and we hear it will be happening again. So you can likely expect the interest rates on private student loans to increase for the upcoming academic year. When it comes to federal student loans, you can't necessarily lock in the rate for the 2021-2022 award year because, like I said, the interest rate only affects loans first disbursed on or after July 1st, 2022. Schools have strict rules on dispersing funds to your account. You essentially have to wait till almost the start, and in some cases until your term is started, for the school to disperse your loan funds to your account. So you can't necessarily do this ahead of time and get it locked in. It's all based on the way your school will disperse your federal student loan money to you. And if your term starts after July 1st, 2022, chances are your loan will have the interest rates of the 2022-2023 award year. Now, when it comes to private student loans, not only are interest rates set by current market trends, but they're also dependent on the strength of your credit history and, if applicable, of your co-signers. Private student loans do let you lock in a rate for a short period of time, but that doesn't mean the time period will allow you to lock in rates now in about May 2022 for a program that'll start in August or September of 2022. Talk to your lender, see how long you'll be able to lock in your rate if you do want to borrow private student loans to help cover your college costs. There's a lot going on with student loans, paying for college, and conversations in the media. To keep up, make sure to subscribe to our YouTube channel and our social media like Facebook, Twitter, and Instagram.